What if after every World Cup final, instead of buying a jersey, you bought the winning country's stock market? Sounds like a genius momentum strategy, until you realize one champion can wipe out years of gains, and the team that wins the most isn't automatically the best investment. If you're new to soccer, here's the quick setup. The World Cup happens every 4 years, and a handful of countries keep winning it. Brazil, Germany, France, Argentina, Italy, Spain. You get the idea. Today we're running a simple experiment. Every time a country wins the World Cup, we invest $1,000 into that country's broad stock market. Then we track what the champion portfolio would look like over time. By the end, you'll know exactly why this strategy feels like it should work, what actually drives the results, and the smarter way to do fan investing without accidentally gambling your future. This is educational, not financial advice, and results depend on your exact data source, timing, and currency conversions. Let's set the rules in a way that's fair and realistic. First, we need rules because invest in a country sounds simple. Until you ask, which market, which currency, which year? Most people accidentally cherry-pick, using today's ETFs for decades where they didn't exist, ignoring dividends or pretending currency doesn't matter. Also, here's the big limitation: reliable, investable country index data is much cleaner in the modern era than in the early World Cups. So any since 1930 claim is usually hand-wavy. So here's the clean version. After each World Cup final, we buy $1,000 of the winner's broad stock market index. Think MSCI style, total return, dividends reinvested. We track results in US dollars because the viewer is in the US. We do this through the modern era where comparable index data exists, and we'll still discuss what earlier winners teach us conceptually. With that in place, you'd expect the best teams to create the best portfolio, right? Not even close. It's natural to think a World Cup win means a booming economy, booming companies, and a booming stock market. But stock markets don't pay you for national pride. They pay you for future corporate profits, and those are often priced in before the trophy. There's even a famous joke indicator in the US, the Super Bowl stock market predictor. It's fun, and it's mostly nonsense. Markets don't work like that long term. A World Cup win can spike attention, tourism, jersey sales, sponsor campaigns, but the stock market is a machine that cares about 1. Earnings, 2. Interest rates, 3. Inflation, 4. Currency stability, and 5. Starting valuation. And that brings us to the first hidden landmine in the champion portfolio: currency. You're a US investor. That means your real scoreboard is US dollar returns. Here's the trap. A country's stock market can go up in local currency, while you still lose money in dollars if that currency collapses. This is where one World Cup champion becomes the perfect case study: Argentina. Argentina has produced legendary players in multiple World Cup titles, yet it has also dealt with long periods of high inflation, capital controls, and sharp currency devaluations. Even if local stocks rise, USD investors can get crushed on conversion. In a champion portfolio, one bad currency regime can drag down results more than a losing team ever could. Winning the World Cup is hard. Beating your own inflation is sometimes harder. So if it's not trophies and it's not just currency, what actually determines which champion investments win? The biggest driver of your outcome isn't who won. It's what price you paid when you bought. Imagine 2 scenarios. You buy a champion's market after years of hype and high valuations. Or you buy a champion's market coming out of a downturn when expectations are low. Same country, same winner, totally different return path. This is why some champions with boring narratives can be great investments if bought at reasonable valuations. In the World Cup, the same countries win repeatedly. That means your portfolio ends up accidentally concentrated. If you invest $1,000 after every final, you're not building a balanced global portfolio. You're building a portfolio that keeps leaning into the same places, like repeatedly adding exposure to Brazil or Germany across multiple wins, while many large markets never show up at all because they never win. That's not diversification. That's a sports history bias. So the champion portfolio isn't global investing. It's a quirky rules-based strategy that can accidentally overweight a couple regions, a couple currencies, and a couple political/economic regimes. So what would I do instead if I still wanted the World Cup to influence my investing in a fun, disciplined way? The goal isn't to kill the fun. The goal is to keep the fun from turning into a financial mistake. Most people turn hype into impulsive bets. They buy the winner at the top, ignore currency risk, and confuse a great match with a great market. Here's the better system. 1. Keep your serious money in a boring core, like a total market or global index approach. 2. Create a small World Cup satellite bucket, something you can afford to be wrong on. 3. If you want to buy the winner, do it with guardrails. Cap any single country to a max percentage, che? Spread buys over time, not one day. And treat currency risk like a real risk, not trivia. And the funniest part? If you do this, you can enjoy the tournament more because you're not emotionally attached to one risky bet. Here's the real result of the experiment. World Cup wins don't reliably predict stock market wins. What mattered more was currency stability, starting valuation, and diversification discipline, not the trophy. The champion portfolio is a great story, but the best takeaway is a framework. Let sports create consistent habits, not impulsive trades. If you had to pick one World Cup winner to invest in long-term, Brazil, Germany, France, Argentina, Italy, Spain, which would you choose and why? Comment it. If you want more sports moments explained with money, subscribe